Okay, then good evening to all. Today I'll discuss some topics about Indian economy and some important part of Indian economy, and one of the important agriculture, industry, money and banking, poverty alleviation and employment generation programs in India, latest schemes or programs of central government, India in global indexes, policy initiatives, foreign trade and balance of payments, transports and communication, public finance, economic planning in India, international organizations. Now, what is about Indian economy? What are the basic characteristics of Indian economy? As you know that India is an underdeveloped economy, there are some characteristics as an underdeveloped economy. Then first is low per capita income. And an underdeveloped country is one in which per capita real income is low as compared to the per capita real income of developed countries. And as our country is underdeveloped country, so our per capita income is also low. Then another characteristics of Indian economy is disparities in income distribution. In India, there is a high degree of disparity in income and wealth distribution. Though the objective of establishing a socialistic society was adopted during the 5 years planning, but it has not yet achieved. Again, another characteristics of Indian economy is dominance of agriculture and heavy population pressure on agriculture. As we know that 70% of people are based on agriculture for their occupation, but there will be no development in that sector. Again, another characteristic of Indian economy is overpopulation. India is overpopulated. In every decade, Indian population gets increased by about 20%. Again, another characteristic of Indian economy is unbalanced economic development. India has not yet achieved the goal of balanced economic development. Again, another characteristic of Indian economy is lack of capital. Savings are low in India due to low national income and high consumption expenditure, and because of this, there will be lack of capital. And we know that capital is formed from savings. As income is low, then from low income, saving is also low, and from that low saving, capital formation is also low. Then another characteristic is backwardness of industrialization. India lacks in large industrialization based on modern and advanced technology, which fails to accelerate the pace of development in the economy. Again, another characteristic is market imperfection. Indian economy faced a number of market imperfection like lack of mobility among production factors from one place to another and lack of specialization. Again, another characteristic is limited availability of transport and communication facilities. And another important characteristic of Indian economy is existence of traditional society. Now, these are about the characteristic of Indian economy. Just before explaining or before discussing the questions, I just give you some ideas about the economy. What is the basic ideas of Indian economy or Assam economy? Next is India is enriched with some mineral resources and forest resources. India, with a diversified natural vegetation, has a geographical area of 32 lakhs 87,263 square kilometer, and periodic assessment of forest and tree resources of the country is the primary responsibility of Forest Survey of India. Forest assessment was started by Forest Survey of India in 1987. Then with the advancement in remote sensing technology over the years, Forest Survey of India is now using latest satellite data received from Indian remote sensing. Now, that another important topic of Indian economy is national income of India. Now, what is the national income of India? I just give you the ideas because there are many topics in this uh, paper. So it is not possible to give the brief ideas of all the topics. So I'll give you just some ideas about it. Now, national income of India. Now, what is the national income of India? The national income means the money value of all final goods and services produced in a country during a year. And generally, it is the financial year. Now, on the basis of this national income, we can find out the per capita income. And on the basis of per capita income, we can define a country as it is developed or underdeveloped. And on the basis of this per capita income, we can define our country as underdeveloped countries. Now, national income is contributed from different sectors, suppose from primary sector, from secondary sector, from tertiary sector, from all these sectors, the contribution will come to national income. Now, an agriculture contribute the maximum part of this national income in India. But it is not developed as many people are dependent on agriculture for their occupation or also for livelihood also, but no proper development take place in agricultural sector. And population is another aspect of Indian economy. As we know that population here overpopulated, India is overpopulated country. And because of this overpopulation, there are some another problem arises, such as unemployment problem. And again, there another problem arises. And because of this overpopulation, as a result of increase in national income, the per capita income will not rise because of this increasing population. Suppose in agriculture, as we know that the main occupation of our country, and many people are dependent on agriculture for their livelihood also. But there are no proper steps taken for the development of this agricultural sector. As a huge part of national part also come from agricultural sector to national income of India. And the performance of agricultural sector influences the growth of the Indian economy. Agriculture has been a way of life and continues to be the single most important livelihood of the masses. Agricultural policy focus in India across decades has been on self-sufficiency and self-reliance in food grains production. And considerable progress has been made on this front, and there are some programs also undertaken for the development of agricultural sector. Now, money and banking, this is another important topic, and I'll give you some ideas about this money and banking. Now, poverty alleviation and employment generation programs in India. Government initiated some poverty alleviation programs and employment generation programs in India. And there are some latest schemes and programs of central government. I have prepared all this. If the time will cover, then I'll give you all this. India in global indexes, then policy initiative, foreign trade and balance of payment. And balance of payment, it can be in terms of export and import. And what is the meaning of this is sometimes export is more than import, sometimes import is more than export. Now, if export is more than import, then it is favorable balance of payment. And if import are more than export, then it is unfavorable balance of payment. Now, transport and communication, it is a important part. And on the basis of this transport and communication, development in different sector can take place. Now, public finance, it will cover all the expenditure and revenue of the government. Then suppose taxes, then direct tax, indirect tax, or the revenue from different sources to the government, all this. And I'll give you this in brief in next slides. Then economic planning in India. I think all of you know about economic planning in India. It is started from 1951. And some objectives are fixed at the starting of the planning, and then some investment are and steps are made for the achievement of those objectives. And after completing the planning, the achievement and success are calculated. Then what are the achievement and what are the successes? Some international organizations just like WTO, IMF, etc. Now, here there are some previous year question answers. That in India, which of the following can be considered as public investment in agriculture? And investment means, suppose you spend some amount of money for some purpose. If there is some return from that, then it is investment. If there are no return, then it is not called investment, just spending. Means suppose you are buying a car for your for luxury, then it is not investment. Or you suppose making a house for suppose your own investment. Now here in India, which of the following question is that question is, in India, which of the following can be considered as public investment in agriculture? One is fixing minimum support price for agricultural produce of all crops, computerization of primary agricultural credit societies, social capital development, free electricity supply to farmers, waiver of agricultural loans by the banking system, setting up of cold storage facilities by the government. Now, here the correct answer are two: computerization of primary agricultural credit societies. As it is computerized, then in online also you can give information or you can take information. This is one of the advantage. Number 3 is social capital development. And 6 is setting up of cold storage facilities by the government. Because in many areas there are no storage facilities for, suppose, some perishable goods. Suppose in case of vegetables, there, as we know that there are perishable goods, Then for those goods, there are no facilities, storage facilities, but now government start to setting some storage, and here it is cold storage facilities like freezing. Um, then another is the weightage of food consumer price index is higher than that is wholesale price index. The wholesale price index does not capture changes in the prices of services, which CPI does. Reserve Bank of India has now adopted WPI as its key measure of inflation and to decide on changing the key policy rates. Now, which of the statement given above is correct? Here, 1 and 2 statement are correct. Weightage of food in consumer price index is higher than that in wholesale price index. Now, what is the use of biosar in farming? Biosar can be used as a part of the growing medium in vertical farming. When biosar is a part of the growing medium, it promotes the growth of nitrogen fixing or microorganism. When biosar is a part of growing medium, it enables the growing medium to retain water for longer time. All are about the biosar farming. All these 3 points are about biosar in farming. Now, what are the advantages of zero tiller in agriculture? Sowing of wheat is possible without burning the residue of previous crop. Without the need for nursery of rice samplings, direct planting of paddy seeds in the wet soil is possible. Carbon sequestration in the soil is possible. And all the 3 are the advantages of this zero tiller in agriculture. Now, with references to pulse production in India, consider the following statement. Black gram can be cultivated as both kharif and rabi crop. Green gram alone accounts for nearly half of pulse production. In the last 3 decades, while the production of kharif pulses has increased, the production of rabi pulses has decreased. Now, which of the statement given above is correct? Only one, number 1 is correct. Black gram can be cultivated as both kharif and rabi crop. Then with reference to the current trend in the cultivation of sugarcane in India, consider the following statement. A substantial saving in seed material is made when bud seed saplings are raised in a nursery and transplanted in the main field. When direct planting of seeds is done, the germination percentage is better with single budded seeds as compared to seeds. One is crop diversification, then ligum intensification, tensiometer use, vertical farming. All these 4 are considered to be practice of eco-friendly agriculture. Now I'll give you just this question and I'll give the brief discussion about this, and you try to find out the correct answer. Which one of the following is not the most likely measure the government or RBI takes to stop the allied of Indian rupee? One is curbing imports of non-essential goods and promoting exports, encouraging Indian borrowers to issue rupee, easing conditions relating to external commercial borrowing, following an expansionary monetary policy. This question is for you. Just try to find out the answer because I'll give explanation about this topic. Again, I'll give you another question. The money multiplier is an economy increases with which one of the following? Increase in the cash reserve ratio, increase in the banking habit of the population, increase in the statutory liquidity ratio, increase in the population of the country. And now what is cash reserve ratio? What is statutory liquidity ratio? I give you explanation about all this. And after that, you just try to find out the answer of these two questions. Now about Reserve Bank of India. It is established in 1935 with a capital of rupees 5 crore. This capital of rupees 5 crore was divided into 5 lakh equity share of rupees 100 each. In the beginning, the ownership of almost all the share capital was with non-government shareholders. RBI was nationalized on January 1st, 1949. And functions of RBI, it is issues of, first function is issues of notes, it issues notes, and it has the monopoly right to issue notes. Then bankers to the government. Bankers bank means the bank can borrow money from the Reserve Bank of India, and government also takes some money from RBI, and it in sometimes it give permission to RBI to issue some extra notes also, and that is called deficit financing. At the time of deficit, the government give permission to Reserve Bank of India to issue some notes to cover the deficit. Then bankers bank, all the banks can borrow money from the Reserve Bank of India, but initially the banks will not approach RBI because of the high rate of interest of RBI. And another reason is that the commercial banks does not want to show their unsound financial position to RBI. And it is also the custodian of foreign reserves. And there are another functions of RBI also. Now, objectives of recent monetary policy. I just give you some ideas because it is not possible to give all the topics. So just give you the important topics. One is the controlling import and exports. Monetary policy helps industries to get a loan at a reduced interest rate, which means they can substitute imports by export-oriented units and in turn increase exports. Promotion of savings and investment. A monetary policy can impact the savings and investment of the people. A higher rate of interest will result in greater investment and savings, thereby maintaining a healthy cash flow within the economy. Then managing business cycle. Business cycle means just like some waves. Sometimes good situation of the economy and sometimes bad situation of the economy. And two main stages of business cycle is boom and depression. Boom is the best situation of the economy simply, and depression is the worst situation of the economy. The monetary policy is one of the most efficient financial tools that can help to control the boom and depression period of business cycle by managing credit distribution and supply of money in the economy. Then employment generation. A monetary policy can lead to reduced interest rates, which means small and medium enterprise can easily secure a loan for business expansion. This means more employment generation. Development of infrastructure. The monetary policy by RBI allows concessional funding for the development of infrastructure within the country. Then developing and managing the banking sector. The central bank is responsible for managing the entire banking industry. RBI also instructs other banks using the monetary policy to establish rural branches for agricultural development wherever required. Additionally, the government has also set up cooperative and regional rural bank to help farmers receive the financial aid they require in no time. Now there are some monetary policy tools, and some important questions comes from this topic, that to control inflation, the Reserve Bank of India needs to increase the cost of fund or reduce the supply of money with the help of tools which are divided mainly into two categories, quantitative and qualitative tools. Quantitative tools, these tools impact the money supply in the economy, including sectors such as manufacturing, housing, etc. Reserve ratio, banks keep aside a certain percentage of cash reserves or RBI approved assets. There are two types of reserve ratio. One is cash reserve ratio. Banks set aside this portion in cash with the RBI. The bank cannot lend this amount to anyone or earn a profit or interest rate on CRR. The statutory liquidity ratio. This portion is set aside by the banks in the form of liquid assets such as bonds or RBI approved securities such as government securities. Banks earn interest on these securities, but it's very low. Then open market operation. The RBI buys and sells government securities in the open market, also referred to as open market operation, to control the supply of money. When the RBI sells government securities, the liquidity is sucked from the market, and buying securities provides liquidity which helps to control inflation. So during time of inflation, they will buy securities, and one of the important questions come that during inflation, how the open market operation operates, which help to control inflation. Again, the main aim of the open market operation is to keep a check on temporary liquidity mismatches in the market, which happens due to the inflow of foreign capital. Now, qualitative tools. These tools affect the money supply of a specific sector of the economy. Now, one is margin requirements. The RBI mentions a certain margin against collateral. When the RBI raises the margin requirement, customers will be able to borrow less and vice versa. Margin require, then customers will be able to borrow, but why margin? Then what is the relation between this margin requirement and borrow? Then customers borrowing. I think all of you know that each bank has to keep some amount with RBI. If RBI increases that amount of cash, then the lending capacity of the bank will be reduced, because they can give to some smaller extent, because they have to keep more amount of cash with Reserve Bank. Then selective credit control. Through this method, RBI avoids lending to speculative businesses or selective industries. Again, moral suasion. With the help of this tool, the central bank persuades other banks to keep money in government securities and not in any other sectors. And another important topic in this money and banking sector is market stabilization scheme. Market stabilization scheme is the instrument used by the Reserve Bank of India in times of excess liquidity. The scheme was brought into operation in the year 2004 to control the surge of US dollars in the Indian market. The RBI uses this technique to repair the excess liquidity prevailing in the market due to the issuance of securities on government's behalf, like treasury bills or dated securities. The fund that the RBI raises under MSS scheme is kept in a separate account from the government account and is not used by the RBI to fund the regular expenditures. This separate account is called the MSS account. To manage the excess liquidity, the RBI issues securities under the MSS, which are called the MSS bonds or the market stabilization bonds. The various financial institutions further purchase these bonds in the country, and the funds earned by the selling of these bonds is Reserve Bank of India. Then monetary policy transmission. Monetary policy transmission is the course of action wherein the monetary policy decisions taken by the RBI, such as the change in the repo rate, are implemented throughout the financial market and especially in the banking sector. The monetary policy transmission impacts the economic condition and activities like consumption of funds and the investment portfolio. One of the most common example of monetary policy transmission is the impact of the repo rate on the banking sector. While RBI has mandated the banks to link their loan product with the external benchmark, a number of banks like SBI, PNB, etc. have linked their retail loan products such as home loans, LAP, etc. to the repo rate. The repo-linked lending rate impacts the loan rate and makes loan affordable for the general public since a decrease in repo rate reduces the loans rate. Thus, monetary policy transmission brings in transparency and affordability. And I'll give you the meaning of this all these rates used here, the repo rate or bank rate. Now, what is the time of the RBI monetary policy? The Reserve Bank of India reviews the monetary policy every 2 months. On December 4, 2020, the central bank released its bi-monthly monetary policy statement for the year 2020 to 21. What is the current monetary policy? As per the current monetary policy, the repo rate stands at 4% and the reverse repo rate at 3.35%. The marginal standing facility rate and the bank rate stand at 4.65%. And all these questions are in previous year, all these questions came. That what are the current rate of RBI? The current rates as per RBI monetary policy are SLR, that statutory liquidity ratio is 21.5%. Repo rate is 4%, reserve repo rate is 3.35%, MSF rate is 4.65%, CRR is 3%, bank rate is 4.65%. I have already explained it, what is CRR and SLR. And these are the RBI bank rate in 2020. Now, what is repo rate? Repo rate is also known as the benchmark interest rate, at the rate at which the RBI lends money to the banks for a short term. When the repo rate increases, borrowing from RBI becomes more expensive. If RBI wants to make it more expensive for the banks to borrow money, it increases the repo rate similarly. If it wants to make it cheaper for banks to borrow money, it reduces the repo rate, and current repo rate is 4%. Now, reverse repo rate. It is the short-term borrowing rate at which RBI borrows money from banks. The Reserve Bank uses this tool when it feels there is too much money floating in the banking system. An increase in the reverse repo rate means that the banks will get a higher rate of interest from RBI. As a result, banks prefer to lend their money to RBI, which is always safe instead of lending it. Others, which is always risky. Repo rate signifies the rate at which liquidity is injected in the banking system by RBI, whereas reserve repo rate signifies the rate at which the central bank absorbs liquidity from the banks. Now, call rate, interbank borrowing rate, interrate paid by the banks for lending and borrowing funds with maturity period ranging from 1 day to 14 days. Call money market deals with extremely short-term lending between banks themselves. After Lehman Brothers went bankrupt, call rates skyrocketed to such an insane level that banks stopped lending to other banks. Then MSF, it is a special window for banks to borrow from RBI against approved government securities in an emergency situation like an acute cash shortage. MSF rate is higher than repo rate. Current MSF rate is 4.25%. Bank rate, this is the long-term rate at which central bank lend money to other banks for financial institutions. Bank rate is not used by RBI for monetary management now. It is now same as the MSF rate. Central bank rate is 4.25. Then another important topic is government budget. Government budget is an annual statement showing item-wise estimate of receipt and expenditures during a fiscal year. The receipt and expenditures shown in the budget are not the actual figures, but the estimated values for the coming fiscal year. Fiscal year taken from 1st April to 31st March. Now, what are the components of government budget? Now, government budget, it can be classified as revenue budget and capital budget. Now, revenue budget, revenue receipt, revenue expenditure. Now, what is revenue receipt? Revenue receipt refer to those receipts which neither create any liability nor cause any reduction in the assets of the government. They are regular and recurring in nature, and government receives them in the normal course of activities. Now, one of the part of this revenue receipt is tax revenue. Tax revenue refers to sum total of receipt from taxes and other duties imposed by the government. And tax is a compulsory payment made by the people and companies to the government without reference to any direct benefit in return. Then non-tax revenue. Non-tax revenue refers to receipt of the government from all sources other than those of tax receipt. And the main source of this non-tax revenue are interest, profit and dividends, fees, license fees, fines and penalties, gifts and grants, etc. And this tax revenue can be classified as direct tax and indirect tax. Direct tax refers to taxes that are imposed on property and income of individuals and companies and are paid directly by them to the government. They are imposed on individual and companies. And indirect tax refers to those taxes which affect the income and property of individuals and companies through their consumption expenditure. They are imposed on goods and services. The ability to pay the tax and actual burden of the tax lie on different person. That is, burden can be shifted to others. Next is capital budget. Capital budget can be classified as capital receipt and capital expenditure. Now, capital receipt refers to those receipts which either create a liability or cause a reduction in the assets of the government. They are non-recurring and non-routine in nature. For example, borrowings are capital receipt as they lead to an increase in the liability of the government. And sources of this capital receipt are borrowing, then recovery of loan, disinvestment, small saving, etc. And capital expenditure refers to the expenditure which either creates an asset or creates a reduction in the liability of the government. Then this is about the government budget. Now there are some other types of budget. One is zero-based budgeting. Zero-based budgeting is a method of budgeting in which all expenses are evaluated each time a budget is made and expenses must be justified for each new period. Then zero budgeting starts from the zero base and every function of the government is analyzed for its needs and cost. Budget is then made based on the needs. Then outcome budget. Outcome budget analyzes the progress of each ministry and department and what the respected ministry has done with its budget outlay. It measures the development outcomes of the government program. It was first introduced in the year 2005. And one important question that come from this budget is that outcome budget is initiated in 2005. In gender budgeting, this is another important topic. The gender budgeting is defined as gender-based assessment of budget, incorporating a gender perspective at all levels of the budgetary process and restructuring revenues and expenditure in order to promote gender equality. It is actually budgeting for gender equity. And through gender budget, the government declares an amount to be spent over the development, welfare, empowerment scheme and program for female. And one important question came in previous year exam that according to gender budget, government declares amount to be spent on which fields? The fields are welfare, empowerment scheme and programs for female. Then balanced budget. A government budget is assumed to be balanced if the expected expenditure is equal to the anticipated receipt for a fiscal year. Then surplus budget. A budget is said to be surplus when the expected revenues surpass the estimated expenditure for a particular business year. Here the budget becomes surplus when taxes imposed are higher than the expenses. Then deficit budget. A budget is in deficit if the expenditure surpasses the revenue for a designated year. And one thing that today I just give you some ideas. If you have doubt, then today as it is there is not enough time to explain all this, so I just give you the ideas. If you have any doubts in all this explanation, then you can write it to me also. Then there are some measures of government deficit, this revenue deficit, which I've already explained. And fiscal deficit, it is the gap between the government's expenditure requirement and its receipt. This equals the money the government needs to borrow during the year. A surplus arises if receipts are more than expenditure. And fiscal deficit is total expenditure minus revenue receipt plus non-debt creating capital receipt. It indicates the total borrowing requirement of the government from all sources. From the financing side, gross fiscal deficit equal to net borrowing at home plus borrowing from RBI plus borrowing from abroad. The gross fiscal deficit is a key variable in judging the financial health of the public sector and the stability of the economy. Then primary deficit equals fiscal deficit minus interest payment. This indicates the gap between the government's expenditure requirement and its receipt, not taking into account the expenditure incurred on interest payment on loan taken during the previous years. Again, the current rate of fiscal deficit is during 2019 to 20, it is 3.3%. Revenue deficit is 2.3%. And primary deficit is 0.2% of GDP. Again, there are some key features of Union Budget 2020 to 21. These are the aspirational India, better standards of living, economic development for all. Then caring society, three broad themes are held together: corruption-free, policy-driven good governance, clean and sound financial sector, ease of living underlying by the three themes of Union Budget. Okay, then thank you.